Before we go further, I will now take a moment to explain about various terms and definitions used in accounting language. It is very important to understand what each term means. Otherwise, when learning about accounting, you may think about something whereas it may mean something else. For example, what is the meaning of income? What is the meaning of revenue? How is revenue different from income? What is an asset? What is an expense? These are all terms and definitions which have an internationally accepted meaning. So I am going to explain to you each and every commonly used term in accounting language. The first term which we are going to understand is the word called transaction. Now, why is it important? It is very important because a transaction, a business transaction, is recorded in the books of account. If it is not a transaction, it is not recorded in the books of account. So it is very important to understand first whether it's a transaction or not. Only then we should record it. What is a transaction? A transaction is a business activity which involves movement of money, goods or services between two or more persons. Let us take an example. A customer walks into the shop and asks 100 questions. What is the price? What are the terms of delivery? What is the warranty? He asks 100 questions. Is it a business activity? Definitely yes. He has asked questions and we have replied. But is it a transaction? No. Because no money, goods or services have moved between the shop and that person. Now we cannot say that the act of giving him the information is a service. It is only an inquiry. A transaction results in movement of money, goods or services and results in a profit earned by the company. Whenever a transaction takes place, the financial position of the company changes. The goods go out, cash comes in, the profit is increased. Thus, a transaction results in a change in the financial position of the company. Even if a customer walks in 5 times asking different questions, each time it is a business activity, but there is no transaction. And only when it actually becomes a transaction, it is captured in the books of account because it affects the financial position of the company. Transactions are of 2 types: cash transaction and credit transaction. We already understood what is a transaction. A transaction is a business activity involving movement of money, goods or services. A cash transaction is a transaction where the payment for the goods or the income has been paid or received immediately. The word cash here does not mean the real cash. It only means the payment has been settled immediately. Whether it is income or expenditure, it doesn't matter. Let us take a case where we purchase raw materials. After purchasing raw materials, we have paid for it by cash. It's a cash transaction. Or if I pay by check, that is also a cash transaction because it does not matter whether it is paid by cash or not. What matters is payment has been settled immediately. Suppose the business pays by credit card. Again, it is considered as a cash transaction. In the case of credit transaction, one part of the transaction takes place today. The second part, that is settlement, may take place at a later date. Suppose I purchase a raw material and I make the payment after 2 months. Then it is a credit transaction. After 2 months, maybe I will be paying cash or by check, it doesn't matter. It is still a credit transaction. Now suppose I make a payment by a check or by credit card. It is again a cash transaction because I have paid immediately. Now what happens if I purchase goods and I give a post-dated check? Then it becomes a credit transaction because payment has not been made immediately. Although the check has been issued immediately, payment has been marked for a later date. It becomes a credit transaction. The entries for cash transaction and credit transactions are different. The tax implications are also different. Therefore, it is very important to understand the difference between cash transaction and credit transaction. So let me repeat. Cash transaction is a transaction where the payment for the goods and services or receipt is settled immediately. Even if it is not cash, it is still a cash transaction. In a credit transaction, the payment is made at a later date, whether by cash or by check, it doesn't matter. In accounting language, we often hear the words proprietor, sole proprietor, partner, shareholder, etc. Now, what do these terms mean? Let us understand. A proprietor means the owner of the business. He is the entrepreneur. He has invested money with the purpose of earning profits. But in business entity concept, the owner is different and the business is different. So the transaction between the owner and the business are also recorded. So when money is received from the owner, we say the proprietor has invested in the business. Now the owner may be one person, or if the business is fairly large, there may be multiple owners. If the owner is one person, he is known as a proprietor or a sole proprietor. If the business is large and multiple owners have invested in the company and they are running the business, then they are known as multiple owners. Now the multiple owners may be partners or shareholders. If it is a partnership firm where multiple partners have invested in the business, then they are known as partners and the organization is known as a partnership firm. If it is an incorporated enterprise, namely it's a company, a private limited company or a public limited company. If it is a company, there are hundreds or thousands of owners. Such hundreds or thousands of owners are collectively known as shareholders because each shareholder holds a share in the company. They are part owner or share owner, so they are known as shareholders. Now, what is the difference between a partnership firm and a company? What is the difference between a partner and a shareholder? We will not worry about that right now. Right now, we will only say that a proprietor is the owner of the company, a partner is also owner of the company, a shareholder is also owner of the company. But if there is one owner, it is known as a sole proprietor or proprietor. If there are multiple owners, they are known as partners or shareholders. Now we are going to understand another important term in accounting, assets. Now, what is an asset? Assets are properties of the organization. They give benefit to the organization. They have a value. Assets are of two types: tangible assets and intangible assets. Tangible assets are assets which can be seen and touched. They have a physical presence. For example, cash is a tangible asset. You can see cash, you can see the coins, and you can see the currency notes. So they are known as tangible assets. Other examples of tangible assets are furniture, machinery, computer, generator. They are all examples of tangible assets. Intangible assets are also properties of the organization, but they do not have a physical presence. You cannot see or touch them. But nevertheless, they are also having value and they also generate income for the company and they are used by the company. Examples of intangible assets are software, patents, trademarks, copyrights, bank balance, These are some of the examples of intangible assets. Both tangible and intangible assets provide value to the company and they are displayed in the financial statements. What is an expense? An expense is the amount spent by the organization to earn an income. For example, in order to earn sales, we need to purchase raw materials, we have to pay for salaries, we have to pay for wages, we have to incur all these expenses, only then we will be able to earn the income. To earn income without any expenditure is obviously a dream for anybody, but this is not possible. All organizations have to incur expense in order to earn incomes. Expenses reduce your profits. Lower expenses means more profits. We have already learned what is an asset and what is an expense. But let us understand what is the difference between the two. Now, why do we need to understand the difference? Because both result in outflow of funds. But an asset is listed in the asset statement, that is the balance sheet, and an expense is shown in the expense list in the profit and loss statement. Very often people get confused between an asset and an expenditure. So let us now understand what is an asset and what is an expense. First, both result in outflow of funds. But however, an expense results in an outflow of funds and this expenditure is needed to earn the income. An expenditure is the amount spent to earn an income. Example, raw material purchased. Without raw material, you cannot produce goods and sell, and it lasts for less than a year. The fundamental quality of an expense is that the benefit of an expense accrues to the company for less than 1 year. Telephone expense, salary payment, raw material purchase, traveling expense, salaries, wages, professional charges. These are all expenses because although money has been spent, the resultant benefit is extinguished within the financial year, within the accounting year. Now, assets on the other hand also results in outflow of funds, but the benefit we get accrues for more than one accounting year. That is, the benefit from that outflow of funds accrues to the company for multiple financial years. For example, if we purchase a generator. Now, generator also results in outflow of funds, just like an expense. But the generator works for many years and gives service to the organization for many years. Therefore, it is treated as an asset. The common mistake which people make while distinguishing between asset and expenditure is they think that an asset is something you can see and touch, an expense is something which you cannot see. It is not like that. A generator is an asset not because you can see, because you can use it for many years. Stationery, paper, pencil, they are also things which you can see, but it lasts for less than 1 year. Therefore, it is treated as an expenditure. To summarize, assets and expenditure both result in outflow of funds, but in asset, the benefit lasts for multiple years. In expenditure, the benefit lasts for only one accounting year. We will now understand the word liability. Liability is a very important term used in all financial statements. It is very commonly used in all financial discussions. Now, what is a liability? A liability simply means the financial obligations of a business. It means what the business has to pay to others. The examples of liability are term loan borrowed from bank, amount payable to the suppliers, expenses payable like pending salary payments, pending tax payments, electricity bill payable. Even the amount invested by the owners are a liability originating from the business entity concept. So when the owner invests the money, the business has an obligation to repay to the owners, and that is also a liability. Now, liability may be broadly classified into liability to owners and liability to outsiders. So to summarize, liability refers to the financial obligations of a business, that is, what the business has to pay to others. Now we'll be understanding some of the commonly used terms in the income statement or the profit and loss statement. They are revenue, profit, income. For a common man, the word revenue, profit, income are all synonymous, but there is a technical difference between the various terms. Now, what is revenue? Revenue is the income received by an organization by way of its normal basic business activity. For example, for a furniture company, the sales income generated by sale of furniture is revenue. Income, on the other hand, is the profit earned after deducting the expenses. Income is also known as the net revenue. So in an organization, suppose there is a sale of 100 crores, and to earn those sales, expenses incurred are 80 crores. Expenses may be purchase of raw material, salary, wages, rent, interest, electricity. After deducting all these expenses, whatever is left, that is 20 crore, that becomes the income or the profit. Revenue is also known as top line. The net profit or income is also known as bottom line. Now this word top line or bottom line comes because the sale is generally depicted in the first line of the income statement, and after deducting all the expenses, the profit or the income is shown in the last line. So it's known as the bottom line. The word profit and the word income are synonymous. There is only a slight difference. Profit means the surplus of revenue over expenditure. Income includes profit and also includes some indirect incomes. Now suppose there is a furniture company. The amount received on sale of furniture is revenue, and the expenses incurred to earn that revenue, after deducting these expenses, whatever is left is known as profit. Now this organization may also get some additional incomes like sale of scrap, or maybe commission or interest. Now these are not the basic activity of the business. So these indirect incomes are added to the profit, and that is included in the word income. So income includes profit plus other indirect incomes. Now what is capital? Capital is a very important term in accounting, but it is one of the most confusing words in English language. Capital has multiple meanings, but we will understand capital from the accounting terminology, from the accounting point of view. From the accounting point of view, capital simply means what the business has to repay to the owners. It means what the owners have invested in the company. Capital does not mean the assets. Capital is just a nickname for the owners. Now, if the ownership is of a single person, one person company, there is only one owner, then he is known as a sole proprietor. Then the amount he has invested in the business is known as proprietor's capital. If there are two or more partners in a partnership business, then all of them have invested money, then the business is said to have capital from the partners. It is known as partners' capital. If thousands of owners have invested money in the business, then it becomes a company, and everybody has invested in a small share of the company's capital, then that is known as share capital. Now, capital, to summarize, capital simply means amount invested by the owners, and it is a liability for the company because this is the amount which the business has to pay to the owners. Now, the next term we are going to discuss is about the ledger account called drawings. We have already seen the word capital, what it means. Same way, drawings is another term which is commonly used to denote the owner. Now, when the owner brings in money, let us say Raj invests money. From the business point of view, Raj has given loan to us, or the business has to repay Raj. This was known as capital account or Raj capital account. By the same way, when Raj withdraws money from the business, let us say he wants some money for his personal use, he takes out 10,000 rupees from the cash box or company's bank account. Then this is a money which the business pays to Raj. Now this amount can be charged to the same account, that is Raj capital account. So whenever Raj gives money, it is added to his capital, and whenever Raj withdraws money, then it is reduced from his capital. But some businesses want to keep these two transactions separate. That is, when Raj gives money, it is recorded in Raj capital account, and when Raj withdraws the money, then it is accounted in a separate account, that is Raj drawings account or withdrawn account. So this is known as drawings. So drawings basically means the same Raj account. So we have two Raj account, that is the two owner Raj account, that is Raj capital and Raj drawings. At the end of the year, the balance in Raj capital account and the balance in Raj drawings account are netted off to find out how much the business has actually received from Raj. This is more commonly used in partnership concerns. In proprietorship concerns, there is only one owner, so they normally have only Raj capital account. But let us say there are three partners, Mr. A, Mr. B and Mr. C. Now, in order to have a financial discipline, whatever A, B and C have invested is recorded in A's capital account, B's capital account and C's capital account. And whenever A withdraws some money for his personal use, it is recorded in A's drawings account. Similarly, B's drawings account and C's drawings account. To summarize, a drawings account is nothing but the capital account only, that is Raj account. But inflow of fund is recorded in A's capital account. Withdrawal by A from the business is recorded in A's drawings account. The next important term we are going to discuss is the term called debtor. The word debtor is a very commonly used term in accounting world. Debtors are also known as receivables. They are used interchangeably. Now, what is a debtor? Let us say my company, Raj & Company, is selling goods to various people. And when we sell the goods and we receive money immediately, that is known as cash sales. Here, the concept of debtors does not arise. But now let us take a case where our company has sold goods on credit. That is, I have sold goods worth of 1 lakh today to ABC, and ABC has not paid me the money. It is probably going to pay me maybe after 15 days, maybe after a month. So then this is known as a credit sale, and when I sell goods for 1 lakh to ABC and company, ABC has to pay my company 1 lakh. So ABC account will show a balance of 1 lakh as due to me. So in my books, ABC will be a debtor or a receivable. Like this, my company may make hundreds of sales every day to hundreds of people. So the ABC and company will be one debtor, XYZ may be another debtor, Kumar and company will be another debtor. Like this, Suppose I have 50 debtors. 50 debtors summed together, I may have maybe 1 crore as receivable. So debtor is nothing but a summary of, a debtor is nothing but a person who has to give me money for the goods which I have sold to them. We will now discuss another term very commonly used in accounts, creditor. Creditors are also known as payables. Let us say our company, Raj & Company, has purchased raw materials from another company, Kumar & Company. Now we have purchased those goods and we have to pay them, but let us assume that we have not paid them. So what happens? I have received the goods, but I owe them money. I have to pay. It's a payable. So Kumar & Company is a creditor in my books. So creditor is basically a loan, but there is a difference between a creditor and a loan. In a loan, we borrow money and we repay money. But in creditor, we have received goods or services and we have to pay money. So a creditor is basically a person to whom we have to pay money because we have received goods and services from them. Creditors or payables are broadly classified into 3 categories for display purpose, for presentation in reports. So we say creditor for goods, creditor for services, and creditors for others. The next topic we are going to discuss is about the term purchases. Purchases refers to purchase of goods. Now we usually refer to purchase as anything purchased. We may purchase a car, we may purchase a machinery, we may purchase a generator, or we may purchase raw materials. But in accounting, the word purchase refers to only purchases of goods which are for the purpose of resale or for the purpose of using it in the production of goods and services for resale. So in my company, Raj & Company, suppose I buy generator or I buy a computer for office use. By English colloquial grammar, we say I have purchased a generator and therefore it looks like purchases. But for accounting, purchase of generator for office use is not purchases. If I am a furniture manufacturer, if I buy plywood, then plywood is purchased for the purpose of making a table and selling it. Or if I am a trader, I am buying stationery and selling the stationery, then purchase of stationery is purchases. Or if I am a car dealer and I buy 10 cars from a company for the purpose of resale, then those 10 cars are purchases. Purchase of goods or services for the purpose of resale are known as purchases. Purchase of assets for the long-term use of the company's in-house using is not known as purchases. Purchases are of 2 types, cash purchases and credit purchase. By cash purchase, we mean we have purchased goods for which we have made the payment immediately. Now it doesn't matter whether I have paid cash or by check. The word cash is just used to denote that I have made the settlement immediately. Credit purchase refers to purchase of goods for which I have not made payment and I am going to make payment at a later date. The purchases are also known as purchase expenses, and purchases are reported in the profit and loss account of the company. They are not shown in the asset side of the company. We will now talk about sales. Sales, we all know, is revenue or gross receipts of a company. But in accounting, sales or sales income refers to the money generated as revenue by a company by sale of its primary products, that is goods and services. Suppose I am a car dealer. If I sell 5 cars in this month, then my sales income is for that 5 cars. But if I have a building which I don't need and I sell it, or I have a generator and I'm selling this generator so that I can buy a bigger generator. Now this sale of office generator is not sales income because sale of generator is not my primary business. Sales income refers to the income received by sale of its primary products, and sales income is shown in the profit and loss account as income. Sales income may be cash sales or credit sales. When I sell goods and I receive payment immediately, now here I may receive cash or I may receive check or I may receive the credit by means of a net banking. It doesn't matter. They are all known as cash sales because the payment has been received immediately. But in the case of credit sales, I have sold the goods today and I will receive the money maybe later in the day or maybe tomorrow or maybe next week or next month. I have not received the money immediately. So when I sell goods and I receive money after some time, then it is known as credit sales. Both cash sales and credit sales are income for the same accounting period. We will now discuss about the next topic, purchase returns. Now what is purchase returns? Purchase returns are nothing but a negative purchase expense. Now why do we take it up as a separate topic, separate term? This is because of just legal compliance, GST, taxation compliance. When we purchase goods or services for the purpose of resale, let us say I am a furniture manufacturer and I purchase plywood as raw material. So as already discussed, purchase of raw materials is charged to purchase expense account. But suppose out of this, suppose I have purchased 100 plywoods and I find 50 plywoods are not good enough, or maybe it is not as per my specification. So I return it back to the supplier and he pays me back my money. Then I will say for the first transaction of 100 plywoods, it is purchase expense, and the second transaction of returning the 50 plywood is a purchase return. Now what is it? Purchase return expense or purchase return income? It is known as a purchase return income because it is nothing but a negative purchase expense. This is recorded in a separate ledger called purchase returns, and it is shown either as an income in the profit and loss account, or it is generally reduced from the purchase expenses account, that is netted off from the purchase expense account to arrive at the net cost of purchase expense. So purchase return is like a negative expense or a income. It is shown separately. Of course, we can always show purchase returns as a negative value in the purchase expense account itself. But we need to report it to the government authorities, as I just told earlier. I have to report separately to the GST department, income tax department, that what is my purchase and what is my returns. Therefore, we record it in a separate account called purchase return account. So when I purchase materials, it is going into the purchase expense account. When I return the materials, it goes into purchase returns account. We will now see another important topic or a term called sales returns. Now what is sales returns? I already explained to you in my previous video about sales income. When I sell goods and I get money, then it is known as a sales income. It's a revenue. But suppose my customer does not like some product, or maybe he finds there is a defect in my materials, or it is not as per his specifications, and he returns the goods, then I have to pay him back the money. When I pay him back that money, now it is a loss for me because sales income was a profit or an income, and now when I return the money, it is an expense. So sales return is just like a negative income. It is the reverse of sales income. Sales return is the reverse of sales income. I can either charge it to the sales income account itself, I have made a sales income of 10 lakhs and I have earned the 10 lakhs. But 2 lakhs my customer has returned to me and I have repaid that money. So I can say I have made a net sale income of 8 lakhs, or I can say I have earned 10 lakhs as sales revenue less 2 lakhs sales return, that is the negative sales, and my net sale is only 8 lakhs. Now both mean the same thing, but because the legal compliance of GST and income tax, they require us to report sales separately and sales returns separately. Therefore, we maintain these two transactions in separate ledgers. So sales is recorded in a sales account, sales return is recorded in sales returns account, and at the end of the year, while preparing the profit loss account, both are combined together to arrive at the net sales. Stock is another commonly used term in the world of accounting. Now, what is stock? You remember when we initially discussed about purchases. Purchases are goods purchased for the purpose of resale or for the purpose of using it up in the production of goods for resale. If I am a furniture manufacturer, I purchase plywood and it is treated as an expenditure. But at the end of any accounting period, whenever you prepare a financial report, the profit and loss account, purchase expenses shows all purchase of goods. But it is possible that a part of the goods are not consumed or not sold. If I am a trader, let us say I have purchased 10 tables. Out of the 10 tables, I have sold only 6 tables. Now it is not logical to compare the purchase cost of 10 tables and the sales income generated from 6 tables. It looked like a loss. So I have to recognize that 4 tables which are included as expenditure in the purchase expense are actually not expenses. Therefore, I will identify the cost of the 4 tables which are included in the purchase expenses and say this is stock. And this stock is reduced from the expenditure while arriving at the profits, so that I compare only 6 table cost with 6 table sales. Now this stock, unsold stock, is shown as an asset in the balance sheet of the company as stock in hand, also known as closing stock. Now next year, this stock will be sold. So closing stock becomes opening stock for the next year, and opening stock becomes an expense for the next year, and it goes on. The next term, which is commonly used in the world of accounting, is the word called voucher. You must have heard about this term called voucher in your everyday life. If you are working in an office, they use the word, where is the voucher? Have you signed the voucher? Now, what does voucher mean? You remember in our earlier topic, we had talked about concepts and conventions, where we spoke about a concept called verifiable object concept. That is, in accounting, it is mandatory that all transactions should have a documentary evidence in support of that transaction. Any transaction which does not have a document is not a valid transaction, and it will have serious legal complications, legal implications. Therefore, every transaction has to have a documentary backing. This document, which is in proof of a transaction, is called a voucher. Examples of voucher is sale invoice. If you make a sale, you have an invoice generated that becomes a voucher. Similarly, if you purchase raw materials, then the voucher for that purchase is a purchase invoice issued by your supplier. If you make a payment for a telephone bill, then the telephone bill generated, which you may receive by email, by hard copy, but that is a voucher. Sometimes an external voucher is not available, in which case company's internal voucher is mandatory. Let us say you pay 100 rupees for some coffee purchased for late sitting for the staff. Now the coffee shop may be a small shop. It is not a restaurant. They may not give you a invoice. So you prepare a voucher in the company's voucher book, write purchase of coffee for late sitting for office staff, 100 rupees, and the cashier signs it, the manager signs it, and it is filed along with the other documents. This becomes a internally generated voucher. But nevertheless, there has to be a voucher for every transaction. Other examples of voucher could be the pay-in slip, which you get when depositing money in a bank, the copy of a checkbook, or the bank statement is a voucher, or online payment receipt generated is a voucher. When you purchase some commodity from, let us say, from an e-marketing website, the packing slip is a voucher. If you pay wages to your employees, then the employee payment disbursement register itself becomes a voucher. Anything, any document in proof of a transaction is called a voucher. Now, what is an invoice? Invoice is another commonly used term in accounting. Invoice, first of all, is like any other voucher. It's a documentary evidence for a transaction. But the documentary evidence in support of a transaction called sales is known as an invoice. It is just another type of invoice which supports a sale transaction. Now, what are the contents of this voucher, namely sales invoice? The contents will be who is the customer to whom you are selling the goods, where is it delivered, how many products have been delivered, what is the rate, what is the total amount, what is the GST component of that, whether it is for cash or for credit. These are some of the information, a detailed information which is present in an invoice. An invoice is commonly used for purchase as well as sales. But a sale invoice is always generated by the supplier, and this copy, this invoice, it becomes a purchase invoice in the books of the customer. So Raj and Company, that is my company, sells goods. We generate a sale invoice. Now this sale invoice becomes a purchase invoice to my customer. In some cases where companies purchase goods from the unorganized sector, let us say I am a manufacturer of agricultural products. I am manufacturing rice flour. I am going to the farmer and buying rice, paddy. Now he is not a company. He doesn't have a sale invoice, in which case in my own company letterhead, I will have a voucher format for purchase. Then this becomes a purchase invoice generated in-house. But all said and done, an invoice is a voucher, a documentary proof in support of a sale or purchase transaction. Another commonly used voucher is a receipt. A receipt again is a voucher which is a documentary evidence or acknowledgement issued by a receiver of money stating that he has received the money. So when I pay some money to another company as cash or check, that company issues a receipt to me. Similarly, if my supplier comes and asks me for money, and if I pay him money, then he has to issue a receipt. This receipt is a documentary evidence which says that I have paid the money and he has received it. Now, receipt is commonly issued by the person who receives the money.